Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
And it's possible maybe this goes for another 3 to 5 years. The longer this goes, the worse the damage is going to be on the other side. But that's just an indication to me that on individuals' behavior, they're believing that this is a new paradigm, that the rules of the past don't apply.
The markets look like they're in incredible bubbles. What do we mean by bubbles? And if a bubble's going to burst, is it going to be an inflationary burst or a deflationary burst? We're going to talk about that. It's a really important topic as we come in towards the end of the year of 2024. Paul Kiker, so good to see you again, of Kiker Wealth Management. Man, I'm ready for this topic.
I am too. Good to see you again, Chris.
All right, so we've made the case over a few episodes, but let's rebuild it for people here. This idea that we're in a bubble. A bubble, how do you define a bubble? What's a bubble, Paul?
Yeah, that's a good question. I've never been asked to actually define the bubble. I would define a bubble as overvaluation that leads to euphoria and delusion, really. And I'll show a good chart here that does a good job representing actually what that would be psychologically. But I believe it's a psychological diversion. If I'm forced to come up with a definition, psychological diversion from reality and long-term fundamentals. Because what we get into in the bubble, and I need to give credit on this Twitter post here, is finance a lot. But the main stages of a bubble. The stealth phase, smart money moves in. We've talked about this a couple of times, moves into the awareness phase. You get a little bit of volatility. They call that a bear trap. So what a bear trap is when you get some volatility in the market and investors sell because they're remembering kind of the collapse that occurred before. So an example of that phase would be kind of 2013, 14, after we come out of 2008, you start to see some slowing in the economic data. Now, granted, the government came in with quantitative easing. What was that, number 2, or were we in Operation Twist at the point? Whatever it was, they were printing at that time. Pushes a lot of people out of the markets, and then it takes off again. Then you start to get in that mania phase. So we've been through the enthusiasm. I believe we're through the greed. I think we're moving from the delusion phase into the argument that this is the new paradigm. So just like anything in our lives, I think what a bubble is we justify the price action. We justify that this is different this time, because as humans, our weakness is to look in the most recent 3 to 5 years and then project that into the future. So I believe it's a psychological thing to where people throw proven fundamentals out the window and convince themselves that this time is different. And I'm starting to see around the edges a lot of quotes that this time is different.
So you're talking, again, that 1929 quote famously by Irving Fisher. He said, "We've reached a permanently high plateau of prosperity."
Correct.
Right. I think he wrote that much to his enduring shit. Like, he'll be remembered for nothing else except that. Might have been a great guy. Might have had a lot of good ideas. But he said that, sort of the Paul Krugman of his day, I guess.
Mm-hmm.
who Paul gets no love from this quarter.
No, not from me at all either.
All right. But that's the sentiment, right? 1929, you're at the terminal stage of a big blow off. It went through all of those phases you just showed us there, right? You get this, top end economist saying we've reached a permanently high plateau of prosperity. You think we're hearing that again?
I do. I really do. And think about that. Put yourself in that time and just what we saw with during COVID with the mask mandates, and people are waking up now like, what were we thinking with the things that we allowed ourselves to be sucked into, right? And then there's still those few that are holding on to it. But imagine the psychological sentiment. How many people were gambling? How many people were in that delusional phase when he came out and made that statement? I would assume, because of human nature and what I've seen in the investing cycles over the past 26 years, there was a sigh of relief that, yes, okay, I know that this doesn't fit the historical textbooks. I know people like Benjamin Graham told us to stay away from situations like this. We know that smart people throughout history got caught up in the tulip bubble, but, technology's here. This is the new paradigm. So I believe that was probably a relief for a lot of investors back then. But, here's one thing that's very interesting. So UBS comes out, one of their research reports recently, and they point out, quote, the current, talking about technology plus stocks, because they're garnering basically all, 35 to 40% of the S&P 500 right now. So their statement is, quote, the current premium is less about the potential of AI. Okay, so rather it is a response to superior fundamentals, namely rapid sales growth, and here we come, a sustainably high EBIT margins. And EBIT margins are earnings before interest and taxes. So there's a quote that's coming around the edges that basically is justifying that these technology companies are in sustainably high earnings. But as I read that, all I could think of was the interview with Joe Rogan and Mark Andreessen, where you've got a government that in the backdrop has been basically protecting through monopolistic powers these top companies. So if they're protected as a monopoly, maybe they've got sustainably high margins. Okay, maybe they do. But the reality is, if the Trump administration comes in, we bring back free markets, or there's a forcing of bringing back free markets at some point in the future, then technology can change quickly and innovation comes in. If those monopoly positions are dislodged, then it's not sustainably high. So that's my biggest concern. We're seeing that around the edges right now, and I don't. It doesn't seem to concern very many people.
We're at the tail end of, I think we're in a super bubble, okay? And it's kind of global. It's across all the Western central banks. And they've gotten us into this massive debt bubble, right? And now they're kind of locked into it. So they have to keep it going. I don't think anybody has a plan. This AI stuff, as much as I see it, it represents to me now, Paul, this idea that it's the bargaining phase of this journey where people are like, oh, AI will bail us out. Right. And it's kind of vague. Remember eyeballs, pets.com, they're not making land anymore. This bubble ain't my first rodeo. Right. So I know it when I see it, because and I've had lots of conversations just this week with people who are very deep into the whole AI side. And listen, there's some things it's going to do that's amazing. But what I can't find is the business case for it. There's trillions of dollars of spending and value and market cap throwing at this. And the question I have is very simple. It's like, well, what are eyeballs worth? Wait a minute. Are houses worth more than they should be? What's the business case? Because at the end, here's the definition of a bubble I finally came across when I was researching the crash course back in 2008, the one I liked best. A bubble exists when asset prices rise beyond what incomes can sustain.
That's a perfect fundamental answer, Chris. I like
right?
that. Mm-hmm.
And then under that, when you ask the question, well, what has to happen for a bubble to occur? The simplest answer, again, and this came from, I think, from Hayek. He said, that's easy. Bubbles require two things. It requires ample credit, because you're not going to do it out of cash flow. So somebody's got to be loaning money into this enterprise. So ample credit and a good story.
We have a good story. We have both right now, actually.
Well, I have that story, right? I have that story as I look into these markets. You and I have talked about the story. The story is, hey, the Fed's going to bail this out. They'll print. It's a story I have. It may or may not be true.
Mm-hmm.
But AI has a story.
AI has a story. And that Fed story is a story that matters in the markets, because it's absolutely terrifying for any of us that are running a risk managed portfolio. When you start to see the markets roll over, they start to move, you raise cash to prepare for the inevitable outcome. And then all of a sudden, out of left field, the Fed comes in and here's, funny money for everybody. And then you have to immediately kind of to retake that position and say, okay, they kicked the can down the road a little bit longer, potentially.
But as they do that, obviously, the pressures get worse and worse. And so at this stage, it's pretty clear that let's just take one example. I think everybody's familiar with this now, that the government, U.S. government, now has $36 trillion of debt. And that's been enabled because the Fed just keeps printing and throwing money out there and reliquefying the capital markets, which is just a one step removed fancy pants way of saying that, if if anybody needs cash, the Fed just prints it, makes sure it's available, right? One way or the other. And they do that by all kinds of complicated ways. Sometimes they expand their balance sheet. That's straight up printing. We're all familiar with that. But sometimes they remove the reserve requirements for banks so they have more cash to use because they have to hold less in reserve. And for anybody who doesn't know, we say we have a fractional reserve banking system. That has not been true since March 26, 2020, when the Federal Reserve dropped the reserve requirement to zero. Remember that? In the depths of like COVID, they just came out with this little announcement. It was on their webpage one day. They're like, oh, henceforth, reserve requirements will be zero. So when, that banks now have to hold zero, which means there's no tether between how much they want to, how big of a loan they want to make and what they're holding. So banks just now can literally, with that requirement, they had a complete license to just print as much money as they want, as long as it goes onto their, liability asset side. So they print money up. It's that's the liability side, but the asset side is what do they buy with that? Mm-hmm. Well, I mean, if you were paying your depositors 0.1%, but you could buy treasuries at 2%, you did that all day long.
Yes.
And then we had the Silicon Valley Bank and Signature Bank blowups in 2022, right? Because that went upside down on them when the Federal Reserve raised interest rates. And here we are. So, Paul, they've just been printing. It's given us some crazy stuff, including this. Again, from the Kobayashi letter. Kobayashi. I don't know how to pronounce it. I'll have to call them up someday and find out. Wrote here recently, just this week, the euphoriometer, talk about what that means in a minute, an indicator of measuring investor sentiment, hit a record 1.1 points according to top-down charts, which is where it came from. This bullish metric uses S&P 500 forward PE, so guessing, what analysts think the forward PE is, the volatility index, or VIX, and the bullish sentiment from investor surveys. And the indicator has now exceeded the previous record posted during the 2000 dot-com bubble. And it's gone from depressed levels to euphoria in just 2 years. This is the most explosive turnaround. Here it is against the S&P 500 in black here. That's the 2000 market top right there. Here we have our 2007 market top, 2008. And this was the panic, and this has been the Fed just reliquefying the whole way.
Mm-hmm.
That's all the Fed knows how to do. So, of course, people have responded. And it's this last little bit from that come down into 2022 up here into 2024 that's caused this explosion right here. So what do you make of that?
So here's all I can think as you're talking everybody through that chart there. First, we have a thought that this is a new paradigm. Mm-hmm. And I've always thought about this, go back to what Christ teaches us. It's not necessarily your actions. It's the thought that ultimately leads to the actions. So first we see the new paradigm in people's actions. So if we go back to that banking situation, the government's like, okay, let's go to 0% reserves, because whispering in the back of their mind, this is a new paradigm. The banks, the Fed can bail out the banks. We're okay. So now you get into investor action. You get this 2022 pullback that starts getting real scary. All of a sudden, there's a little bit of liquidity in the system. And then now everybody behaves on this new paradigm with that euphoria that blows through the delusion, right? So I think that all that is actions that are now leading to statements that are the new paradigm, because it's a thought in the back of your mind. You act based on that. And then when you get rewarded for it, now you start saying it out loud, because it's like, holy cow, can you believe what happened? We're in this new paradigm now. So I have to change my, we have to throw out all the old rules. And I believe that that's a sentiment where I'm seeing across the board right now, whether it's demoralization of individuals that have tried without a strategy to wait this out until the market came down, right? And then it never did. And it just keeps lasting longer than anybody can imagine. So I think it was Jesse Livermore, which was a legendary trader, said the market can stay irrational longer than you can stay solvent. And going back to basically, if you short the market and the market continues irrational, it'll wipe you out regardless of fundamentals because that behavior takes over. And I'm seeing ridiculous bullishness and ridiculous complacency kind of across the board in the investment world. There is a recognition that we're in a bubble, but the argument is this is going to be like the late 1990s bubble, and we have more time, right? We have more time. And it's possible maybe this goes for another 3 to 5 years. The longer this goes, the worse the damage is going to be on the other side. But that's just an indication to me that on individuals' behavior, they're believing that this is a new paradigm, that the rules of the past don't apply.
Yeah. Well, let me point out one other thing from this chart, which is that it used to be, excuse me, back in the day, when I think this was back in 2000, these were humans actually trading back then. Today, it's computers trading, okay? Mostly, just from a volume standpoint, but also from a speed standpoint and also from an emotional standpoint. Silica algorithms are not humans with standard greed and fear circuitry. But see this big old top up here? This took time, right? 2000, it was 1998, 1999, it was 2000. Big old sort of a rounding process. And then even this is kind of slow and it's a fall. And then you get to this bottom, there's a couple bumps there. Something changed around 2008 where computers really started to take over. And you see that bottom? I remember that bottom. That bottom lasted hours, right? Yeah. Everything was falling and then it wasn't. And I was like, huh. And I should have wised up at that point. I should have said, oh, new sheriff in town, something different. But I'm convinced, Paul, that the powers that be, the whomevers, when they decide they get a little freaked out and they want to just dump money in and get this thing to change course, they can do it instantly now. And so you see, that's very sharp. That's a needle. I call them needle bottoms now. Bottoms used to be W's to me, or U's. They had a shape. Now the shape is a needle. It's like it's plummeting and then it's not, right? You know, and so here you see a big, long topping process that happened here. But again, it just needle bottomed out and came up, and that's a needle. And so I'm convinced that the Federal Reserve et al. And Wall Street collectively, I don't think they have a plan, Paul. I think their plan is make stuff go up and to the right and hope something like AI comes along and bails it. Like there's some new economic engine, right?
Yeah. Yeah.
You know, the internet story, okay, the internet truly transformative, right? Mm-hmm. I get that. Housing wasn't transformative, right? It just didn't make sense. Like, how is a house worth more than it costs to build? You know, it's not. You know, we had this whole fantasy. The story was, oh, your house is an asset. Look at all these assets people have. You heard Greenspan and then Bernanke come out and say, oh, people are tapping the equity in their houses, right, with the HELOCs and all that. You know, they're unlocking the equity in their homes. It's like, no, they weren't. A house is a liability, not an asset, because assets put cash in your pocket. Liabilities take cash out of your pocket. So that was just speculative fervor there on asset prices. But now what's our story? What is that new giant economic engine of growth? And people are saying it's AI.
Correct.
I'm stuck again. And I don't get it. And, you know, I need to be 23 to understand this stuff these days because, you know, new paradigms are hard to get your head around. But Paul, here's how I see it. I'm a big company. I'm IBM. I suddenly get AI. AI can suddenly, means I don't need this entire department of people because I don't need them anymore. And so now I have a more profitable business. Mm-hmm. But I just had to fire half my staff.
Correct.
They are no longer earning big salaries, part of the economy. So unless AI means machines selling goods and services to other machines, I don't, it's a two-faced coin. I get it. Yes, it's going to be good for corporate profits, but it's going to be terrible for wages and earnings. And therefore, it's pretty much of a wash.
Let me see if I can find that data here. I will say this. So non-AI startups or unicorns, as they call them. Okay. Mm-hmm. This is going to be close, guys. It's not going to be exact. So don't hold me to the exact numbers, but it's approximately 420 employees that a unicorn startup has that's non-AI. AI unicorn startups are around 200 employees. So that's 50% cut in the workforce. Mm-hmm. So if let's say we get the Department of Government Efficiency in there and you don't have an administration that's just willy-nilly hiring employees to keep unemployment looking good. If the government's not going to absorb these employees, where are they going to go? And then that's less people purchasing more goods. So, this is one of those things where technology is inherently deflationary. So the expansion of AI, and if it is adopted, let's say it eliminates 30% of the workforce, that helps profitability dramatically. But if you have an over-leveraged society, you have a recklessly spending government that's reached a point that that it's unsustainable from a long-term standpoint. When we have to reset that system, we're going to exit this new paradigm, go blow through the other side of the delusional phase and back to reality. And unless the government's able to come in and just print us into oblivion, that tends to be deflationary. It should be deflationary, at a minimum deflationary back to long-term sustainable fundamentals, because where are people going to be employed?
That's a good question. And by the way, when we look at credit cards here, over $1 trillion, so again, this is in that entire euphoria phase, where people are suddenly, it maps, doesn't it, Paul? Mm-hmm. Remember, we saw that euphoria really take off in 2020. We see that 2022, you see that big bolt in the euphoriometer. So people are, dude, we're like, this is it. This is the roaring 20s. You can feel it, right? Pile it out. Like, dude, anything goes, nothing matters, right? YOLO, right? Just put it on the card, buy the stocks. It's incredible what's going on right now. And somehow we're going to have this thing where you have all these people getting really over leveraged. And by the way, an Escalade, I think, was 50, 60,000 just like 10 years ago. I think they're 130,000 now. That's minimum. Insane. I know it's a nice car, it's a Cadillac, all that, but but people are like, I could show you an equivalent for auto loans, right? Mm-hmm. We have student loans. So household debt we're just stretched to the max, and then we're just going to fire 30% of these people because AI is coming along.
Right.
I don't know if anybody's thought this all the way through yet, but so AI, deflationary is what you're saying.
Yeah, AI is inherently deflationary. So I have actually found just a personal story. So I've been looking how to use AI within my business, right? Mm-hmm. So a lot of things it's done is a supercharged internet search. It makes things a little bit more efficient there. So there is a little bit more efficiency in finding information. But again, going back to the trading algorithms, I'm just going to table this and plant a seed. We can see the biases depending upon who put those artificial intelligence together, because there's programming involved. Our biases are subconscious in so many areas. So I've looked at its efficiency. So now there's this new artificial intelligence program that's come out kind of not only for the financial advisor industry, but you have an app that you can plug it in for a phone call. Now, we have not implemented this. I would tell anybody that I talk to if we have it put in there, but I have a friend that's been using it. And it immediately summarizes, take notes of the whole conversation, and then comes up with bullet points, to-dos, all of that. He was just absolutely amazed. He's like, Paul, literally when I get off the phone call with my clients, within 2 minutes, it has a summary of our phone call, the action items, and I can put an email together and send it out to clients on what to do. So that normally it takes 45 minutes to an hour to really go through, talk to your team. So that's a lot of that's a lot of extra capacity that comes in for communicating with individuals. So that's going to be ridiculous for my productivity if this is something that we actually implement. But it's not life-changing. It helps me to be more efficient so you can squeeze some more contacts in your day. And it probably also eliminates adding another employee at some point in the future, because I'm more efficient in what I'm using, and not adding more employees is deflationary from a long-term standpoint, because that business can grow without adding those employees. So what's going to happen is the people that are adopting this the rich are just going to continue to get richer. And the more imbalanced that economy becomes, the more demoralized we're going to have with the underlying society, and it's completely unsustainable from a long-term standpoint. And those of us that are using that, and, and have made good decisions in the past, start to rely on that wealth and believe that that wealth is going to protect us. And then debt doesn't matter because I can cover it. And all I can think of too is these long cycles we go through, Chris. A lot of the baby boomers look at their parents who came through the Great Depression, who refused to take on any debt whatsoever. Debt was a bad thing because there was no fear of debt in the roaring 20s. And then it just absolutely upended the lives of a whole generation. But now you've got this other generation that's looking in the rearview mirror that's going, well, I wish I hadn't listened to my parents, and I wish I'd have borrowed more money, and I wish I'd levered up a little bit more. And those wishes have turned into actions, and all of the government fuel has just fueled this bubble. And this is not going to end any different than what it did before. When this thing cracks, those who believe that their wealth is going to protect them from foolish behavior and human weaknesses are going to be the most let down on the other end of this cycle.
I mean, this is a big, giant conversation because I use AI as well. It's astonishing how much time it saves me on certain research things. And I'll show you an example of that in just a minute because I think there's something important here. So it gives me quicker insights, which is fine. And that's what I do with my tribe is I go out and I find insights as quickly as I can and see if we can turn that into actionable intelligence, right? But let's back up a second. I think we have to have a foundational conversation, which is, well, what is money, right, to start with, right? Because here we are, we're talking about money and how to grow money, and we interchangeably use that term with wealth. And I think actually those are separate terms because money is a claim on wealth, right? Real wealth, as you know, is your health, it's your friends, it's the house you have, it's the land, it's the productive enterprise, it's how good your employees are, and how well they fit into your enterprise. That's real wealth. And currency is this stuff we use to sort of like trade across and among those things, right? Mm-hmm. There always has to be a balance between the amount of that currency and the stuff being produced. That's what the Fed was supposed to do. Milton Friedman famously said back in the day, he's like, you could run the Fed with a laptop computer, right? It's not a big deal. You just want to make sure you have enough currency floating around so that all the things people are doing have sufficient lubrication. The problem is that we have this system that allows certain groups of people, the capitalists, the so-called billionaires, to start accumulating more than their fair share of this pie, right? And now we have all these billionaires doing things like Bill Gates and throwing their weight around and, doing stuff that maybe a lot of us wouldn't agree with necessarily or entirely in that particular example. So somebody tweeted the other day and they said, hey, how about we say that the most you can actually accumulate is 999 million. And then you get a plaque that says you won capitalism and we name a dog park after you. Right.
I like that. That's good.
But we're at this point where if you understand that exponential accumulation function, so let's say I'm Bill Gates, let's say I'll just make a number up. I have $100 billion to my name, and I can only possibly spend $1 billion. I mean, I'm throwing what, $3 million a day out the door, just living, right? But I take my 100 billion and I park it in something that's accumulating 5%. Well, I'm getting 5 billion coming in. I can only spend one. What do I do with the other 4? Well, I put that on my pile for next year. Now I have 100, and it just goes off very quickly. And we're at that stage where all the currency units are being vacuumed towards a very small group of people. And that, of course, leads to Plutarch saying, which is the oldest and most fatal ailment of all republics, is a gap between the rich and the poor. Mm-hmm. We just saw this United Healthcare CEO get gunned down. And Paul, I got to tell you, the amount of Schadenfreude, the amount of people saying, I'm not at all upset by that, it was astonishing. I think it exposed something here, which is already we're feeling that social tension of that gap. And I think AI is going to take that gap and put it on steroids. Mm-hmm. Right?
I do too.
Because what your story tells me, you don't need an executive assistant anymore, right? That's a job gone.
That's right. Instead of after it's over, picking up the phone and calling a dictation service or using a program and then having the assistant that goes through and summarizes it, posts out all the to-dos and all that stuff. That's one less person gone. That's just on that component. Well, if you add another if I was at another 40% capacity to my week, for example, just by being more efficient in that, well, now you can take on 40% more relationships, and that's one less advisor that you need. So that's actually 2 employees instead of 1 that it can eliminate in that situation, and it increases profitability. But here's the sad part about it, Chris. Now, all of a sudden, the pace of our life moves faster because those that are implementing this are starting to separate from the other individuals. So now you've got to implement this, and it's that treadmill just gets faster and faster and faster. So the technology hasn't been used necessarily to make our quality of life better. It's all about this treadmill of just trying to maximize profitability. Some individuals are doing it because they're trying to maintain their standard of living due to the loss of purchasing power through inflation. And others are implementing it just out of pure greed, right? Just pure greed. All of us have to determine at what point have you accumulated enough, right? At what point have you reached escape velocity? And some people, it's what they call the FU money, right? They get to the point that they can just speak honestly about everything across the board, and they try to take that time and those resources to change the direction of our society. To an extent, I think we saw Elon Musk do that with the purchase of Twitter, X, which is now X. So, God didn't create us to live with a treadmill that just continually ramps up to try to make ends meet and maintain our standard of living.
Hello, everyone. I'm Chris Martinson of Peak Prosperity, and I want to tell you about something. So, you probably heard about the Great Reset. You know things are highly uncertain right now. There are things happening in the markets that just don't make a lot of sense. And there's an unfortunate conclusion lurking under all of that, which is that there's some people out there, I call them the raccoons of Wall Street, who have found ways legally, air quotes, legally, to take your money, your wealth, your stocks, your bonds, maybe even your house from you. This falls under the idea of something called the Great Taking, and it's a fairly complicated topic, but this is what I do, and I do exceedingly well. I will find ways to understand this and communicate it to you, and I'll find the other experts out there who are just the best at figuring out what you can do and how you can understand this thing. Now, I hope that nothing comes of this Great Taking idea. I hope that the trigger is never pulled, but it might. So to help you get there, we have the Great Taking webinar, a variety of experts, and we have 7 strategies that we will outline and also are contained in this workbook that comes along with the Great Taking. It's there anytime you want. Once you have secured your access to the Great Taking webinar, you'll be able to download it, look at it, and view it anytime you want. And you should actually do this with people you love, other people you care about, and anybody else you think who might need to know this information. So with that, please consider taking advantage of this amazing offer to get educated and then take action to protect your wealth, because the Great Taking is a very real thing. Obviously, they wouldn't have spent so much time finagling the law and putting in this trigger if they didn't mean to pull it one day. Let's hope that they don't, but if they do, I want you to be on the right side of the line so that you're not on the Great Taking side of the line. Now, back to our program. A lot of people could probably say a statement that's like this, like, if inflation was 0, I have enough to retire on. Mm-hmm. If inflation is at 4%, that's my asymptote. That's my I don't know. It's getting tight. If inflation is 5 or more percent, I'm hosed, right? Mm-hmm. So I have to keep working. So it's that uncertainty because we don't know what inflation is going to be. We just know the Fed has said, well, 2% is the floor. We have a minimum threshold of inflation. They've been making those bubble noises about, well, maybe it should be 3 or 4, right? Because it was 3 or 4. So it's just self-serving claptrap. But this is the driver of a lot of it for me. This is federal government current expenditures, interest payments, just paying interest. This is highly inflationary because that's cash out the door. So when the government is spending $1.1 trillion per year on interest payments, Paul, those go to the people who hold the government debt. Mm-hmm. That's $1.1 trillion of cash going out from the government door into whoever's holding all of that debt, right? And that's a combination of foreigners and domestic. But blah, blah, blah. It's mostly wealthy individuals or entities holding all that. That would be the Yale Endowment. That would be the Pritzker family. That would be, big banks, money center banks, et cetera. But that's highly inflationary because that cash has to come from somewhere.
Mm-hmm.
And it's not coming from income tax receipts, which would be the non-inflation. If the government had to live within its means, this would actually be a deflationary chart because the government would have to be pulling that from income tax receipts. It would sort of be a wash in essence. Mm-hmm. So they'd be pulling down demand because they're taking so much cash from people to give it to these people and et cetera. But they don't. Obviously, they're running, massive $2 trillion a year deficits, which means this is inflationary right here. Mm-hmm. So when we get back to our original hypothesis for this thing, are we going to? So I'm I'm positioning myself personally, full disclosure, towards what I consider to be the old playbook, Paul, which might be wrong, but there's some sort of a scary decline in the markets that gives the Fed the cover they need to do more of this stuff we're talking about, which is to open the floodgates again. That's the deflation first, then inflation. Kapoom, as Eric Jensen of iTulip called it back in the day. Or do you think we just go straight to the inflationary phase? They just skip that little kabuki theater first step and just say, print. Where do you think we go here?
It's possible that we move into the inflationary phase. I haven't ruled that out, and that's one thing that's in our playbook that I keep telling myself. Now, I'm 80% on the side that we're going to have that deflationary decline. And I still think that they need to generate enough pain because one thing that we can see is the American people spoke. I mean, nobody in the media said that they thought Trump would get the popular vote across the board. Okay. And I think that's a response to the inflationary pressures that people have felt for the past 3 to 4 years. So we've had political voting in a direction that the media certainly didn't expect to happen. And even those of us who knew we needed to change didn't think that it was that prevalent across the board necessarily. I thought it was, but I didn't think it would necessarily be that strong of a statement. So I don't believe that they want it to go straight into the inflationary side because now you're going to have people that are going to know exactly what they're doing and it's going to be clear as day. And the that pressure of life is just going to continue to crank down and they're going to fall behind. And I believe that would lead to a revolt quicker than if we had an economic cycle, they allowed a little bit of one return, the market drops 50%, deflation occurs in the interim period, and maybe it goes down 50 or 60, and the large majority of the population loses their job, right? Let's say you go to 10%, 15 or 20% unemployment, which would be Great Depression levels. Well, all of a sudden now it's like, I would rather have that inflationary pressure than no money coming in to pay my bills. So that's the reason I think just psychologically that we're still going to enter that big downturn in the markets. However, I believe that we're going to have that inflationary crack on the other side, Chris, but I have changed my thesis a little bit over the past couple of years. Because I think for American investors, because when you look at what has happened in the U.S. markets, and bear with me, I want to pull up these charts to reflect it, and it'll take me just a second here. I want to go to interest rates. Okay. So what I want to show is the U.S. has garnered all of the assets relative to the rest of the world for the past, and I know I've shown this chart before, but for the past 16 years. So let's share this. There we go. So what I'm showing here is the major market indexes, S&P 500, the Goldman Sachs Commodity Index, the MS Morgan Stanley EFA Index, and emerging markets. So developed markets, commodities in blue, emerging markets in green. If we go back to January 1st, 2008, emerging markets is still 11% below what they were 16 years ago.
Wow.
Developed markets, Europe, Canada, the developed market index is 3.7% above what it was 16 years ago. Commodities in general in that index are 11.6% below what they were 16 years ago. U.S. equities up 311%. So, that's a dramatic outperformance that has been fueled by behavior, right? So investors are just chasing what is working, and that's another thing that adds fuel to this. So my concern is if we have that crack and if we have that inflationary boom on the other side, that more than likely means dollar strengthens dramatically in the short run. Brent from, I can't think of his last name right now, from Santiago, dollar milkshake theory, right? The dollar strengthens in the short run. The government prints. The dollar, in one report I read the other day, is down to 50% of global trade now. The BRICS, naturally gravitate towards stronger currency behavior. You have a currency that collapses in the U.S., and now all of a sudden you have funds that are fleeing the U.S. into the rest of the world. So my concern is that for U.S. investors that think that playbook's going to be the same as what it was before, that we're going to end up in a situation for U.S. investors that's going to be very similar to what the Japanese investors experienced after their bubble burst in the late 1980s. Because after all, Japan has set the standard for printing and artificially holding interest rates low. So what happens, Chris, if this is what occurs to American investors? Do you know anybody who has any plausible theory that the U.S. equity markets could be down for the next 34 years?
No, 34 years. That takes us out to 2050. I think the world's kind of like, I don't know what it looks like in 2050, but it's, nobody has that amount of time. And by the way, that whole sustained rise there in Japan on the right side of that chart, right? Mm-hmm. That's with them taking debt per capita and absolutely smashing it through the roof because they have a declining and aging population. Mm-hmm. And they've just been printing, and that is 100% manufactured up into the right behavior by the Bank of Japan, who have ruined the economic future of their countrymen.
Mm-hmm. They sure have.
Because they needed prices to go up and to the right. It's a central banker thing. But it's so irresponsible. I think it's immoral, not amoral. I think it's but yeah, they've got a debt problem. Someday, the yen is my dark horse candidate for first major currency to fail.
Yes.
Mm-hmm. Because of that whole, and they kept more money in the system. It's like, no, the money's supposed to serve and facilitate trade, and trade is what people do. So if you have fewer people, and that's what they have in Japan, mm-hmm. right? Then the economy can shrink. That's okay. Mm-hmm. The problem is the banking system doesn't like to be able to do that. So banking system needs more money in the banking system. And that's who central banks serve.
That's right. That's who they serve. So, if we go back to that thought experiment, because we have an unknown future, and I spend a lot of my time, okay, so our strategy is designed to be able to make adaptations, okay, because I wanted to have the flexibility to be able to go outside of my preconceived ideas with measurable data that gives us confidence to make that decision. Because if you don't, you're speculating, right? There's mm-hmm. so many people that are speculating right now because they don't have some measure, and you can adapt those measures. So by having tools that can tell you, okay, what if the U.S. ends up like Japan did? When's the average investor going to realize that you should have moved the large majority of your assets into other countries? What if a Japanese citizen on that first crack, you ride the wave in Japan, you get that first crack to the downside, and you have something that says, okay, I'm a Japanese investor, but you know what? The U.S. markets are really strong because in the 1990s, the U.S. and let me show that because I want to go back and show this just the response that happened on the other side. So I don't have daily data going back prior to 1994 for emerging markets, commodities, and developed. So that starts really 1994, 1995 on those. But it doesn't really change the outcome that much because if you look at the S&P 500, when that bubble burst in Japan, there were some investors that were smart enough to kind of gain, especially that bubble that was in 1995 where the U.S. took off. From 1995 right here to the year 2000, if we go back and look at what occurred in Japan. So this is 1995 right here, all the way down to the year 2000, where it was basically sideways.
Mhm.
So what if you were a Japanese investor and you had a strategy that told you to overweight the US markets? Then you escaped that period of time far better than what the average individual did. So that's one of the things that I'm looking at. I'm always trying to game, okay, if I've considered a possible outcome, whether we get there or not, and our rules are pointing us in that direction, I'm not having to overcome my biases because I've already considered it, and I can move one or two steps faster. And I believe that that's where investors need to be right now, is enjoy this rally that's taking place in the market. Enjoy it. Okay. It's unprecedented historically. What would have been wise decisions for individuals back in the year 2000 to do when we broke all of those historical parameters of 1929? And there was the thought that, hey, it's the new age, it's the new economy. Warren Buffett doesn't know what he's doing anymore. If some of those investors had harvested some of those profits and maybe paid off their primary residence, or reduced some of their credit card debts, or gotten themselves in a more solid foundation, or built themselves 24 or 36 months worth of emergency funds by sweeping that profit off the top, they were more resilient over the following years. So one thing I would encourage investors to do out there, hey, you may feel like a fool for a year or two, but this is not going to end well unless we have truly entered a new paradigm. And that's been attested so many times throughout history. So if you've got these ridiculous, crazy profits out there, sweep some off the top, right? Sweep some off the top, reduce your debt, build up your emergency fund. Maybe pick up some precious metals from a long-term standpoint, not a recommendation. You need to seek counsel on that. But if you don't have any, sweep those profits and diversify where you are, because if it's not different this time, you're going to look in the rearview mirror with regret and say, I wished I'd have been a little bit more prudent. Okay.
Yep.
And the prudent decisions are not the most fun in the short run. Okay. You know, going and drinking yourself into oblivion, swinging from the chandeliers and, at the club at 2:00 in the morning. And, you might get away from that, but, there are typically always consequences. It may not be as fun in the short run, but the individual that was sitting at the dorm room studying their little rear end off to give themselves better skill set for the long term didn't have as much fun in the short run, but they made the sacrifice in the short run to be in a far better position in the long run.
Well, and of course, the Federal Reserve has been very active in punishing the prudent and rewarding the chandelier swingers and all that. So let's talk about this then, in starting with the Japanese model you gave out there. So I'm going to show something here. And this gets us back to fundamentals, because I think fundamentals at the end, Paul, have to play a role. And that's really something that's been forestalled for a long time. So what I'm showing you here is in blue. That blue line is the price to book of the S&P 500 index coming in through 1990, up through the mid-90s, coming up into 1999. And this is 2000 right here. Mm-hmm. Okay. So I bet a lot of people bet if they lost, got their 401k turned into a 201k during that period, I bet they wish they could go back and say, oh man, that was just so obvious. That was just unsustainable, because here's what happened after 2000. Okay. So we had that big rise to 2000, and then price to book, we had the market crack and it came down and really falling. And by the way, just to put this in context, this is 2005 to 9, this chunk right here. This price to book, even during the mania of 2008, remember? So we had that whole housing bust. Stocks weren't participating. That was a housing bubble burst. So price to book. So what's book? What does that mean for people who don't know? That's the price you're going to pay for a share of a company relative to its book value. Now, in a book value, a lot of people say that's a stodgy thing, because that's just adding up, Paul, if I had to liquidate this company, what would it be worth, right? That's its book value. It's tangible, property, plant, and equipment. Kind of stuff. And obviously companies are worth more than just the sum of the bricks and the mortar and the machines, right? I get it. Mm-hmm. But it's a good way to look at it, because ultimately that's what you produce things with is your book. So it's a fundamental value measure. Now, what do you think it looks like coming out when the Fed started to do what they were doing? Well, let's take a quick peek. Oh, price to book is back to the same blow-off levels that it was in 2000. And what you're saying is there are going to be some people probably kicking around in a few years going, man, I wish I'd read that sign properly. I know a lot of people wish they'd read it properly here. It's always easier in retrospect. But you can see here the Fed has clearly had a point of view. You could draw a ruler straight line on this. There was a little downturn in here, and then in COVID, then the COVID blow off, then this. But this is the period of time we're in right now. It is one of the fastest, most sustained rises in price to book that we've seen outside of the COVID $5 trillion printathon. Mm-hmm. It's pretty profound. And again, remember, if a bubble is when asset prices rise beyond what incomes can sustain, the price to book is that fundamental measure of the income in essence. It's like what's the core underlying value that we can put out here? And maybe this is AI. Maybe the world has changed and I haven't recognized that yet. But that now I have to fall back on, what are those 4 words? This time is different.
Correct. Well, and let's say it changes, Chris. But let's go back and look. When the 2000 to 2003 bubble burst, I remember that clearly. There were people that were warning about it, and people were ignoring them, right? Oh, well, somebody was warning in 1995. Well, quote, you're an idiot. But when the market broke in 2000, it went down into 2003. Housing was actually really affordable. Okay, back during that time, for most of the country, you could buy a rental property because they weren't that popular, as popular as they are today. And the rent was affordable for the tenants that were in there, would pay for that property in 7 to 8 years. Okay. So by the time we get into 2007, you have a real estate bubble, but not a stock market bubble. And I remember that period of time because a lot of our area's builders and real estate investors, and I mean, it was an absolute mania. And I had people that were friends of mine. They're like, Paul, I'm so sorry you do what you do for a living. If you'd have been a builder, or if you'd been all into real estate, that, like, they felt sorry for me, right? Now with the risk managed strategy on the other side of that was a completely different story. That coin turn, that's the long-term game. But we didn't have a fundamental bubble in equities. It was in the real estate market that nearly took the banks down, and you had a 57% decline in the market from top to bottom at that point. Where we are today, housing's unaffordable, rent is unaffordable, cars are unaffordable. The stock market is at the most ridiculous, historically dangerous levels that have been a clear warning. You don't know how close we are to the top, but we're within a top, even if we set higher records on everything that's taken place there. So what's going to pick up the slack on the other side of that, right? So if AI is coming in and it's putting pressure on real wages rising, and it's basically eliminating jobs, which is what it's going to do in the future, then this is the everything super bubble that, could turn into a deflationary event that spirals out of control like 1929, and maybe printing money doesn't necessarily turn things around because there's so much damage within that system within it cracks. We can't rule out that possibility, I don't think. Do you, Chris?
No, and it's why I preach resilience, and I think people should have multiple streams of income and have their money managed really, really well, and think about having a garden, because, we might be back to victory gardens or 1929-30 style survival gardens. I don't know, because it's never different this time. There always has to be this fundamental relationship between what you're producing and then the claims that are put against that. So, look, this is a longer term view of that same chart we were just looking at, U.S. price to book. People were smart, Paul, back here in the 30s and the 40s and the 50s and the 60s and the 70s and the 80s, just as smart as they are today, right? We're no smarter than we were back then. Nope. And then this is where things went off the rail. This is where we got our first activist Federal Reserve chairman, and that was Alan Greenspan, Mr. Mumbles. Mm-hmm. 1987 crash happens, and he puts out the famous Greenspan put. Oh, this is terrible. Because he hobnobbed and he hung out with Wall Street people, and he was all enamored with that lifestyle, and he liked being famous, and he liked being able to mumble jargon and nonsense, and people slavishly saying what an amazing man he was. He loved that. Well, this is the Greenspan put in operation. Mm-hmm. And it blew up, and that would have been a great time to sit back and go, maybe we shouldn't have done that. it kicked off moral hazard, and a lot of people, a lot of innocent, ordinary people, hardworking people, got tanked. And I was one of them, Paul.
Mm-hmm.
I was here. I was a genius, right? Because I just had this broker at Merrill Lynch, and I would just take, money that I was earning. I was working at Pfizer at the time, of all things. I was in corporate finance, and then it broke, and I had no idea what happened. I was like, what? And, my broker was giving me things, stocks for the long haul. I was unsatisfied with that, so I started looking into things. Frankly, this is why we're sitting here talking today, because when that break happened, I got curious. And ultimately, that led to this thing called the crash course I came up with. But fundamentally, at this point, this would have been a great time to say, you know what? We get this. We're fine. We're actually at an elevated end of a multi-decade sort of range.
Mm-hmm.
And that was unsatisfactory to them. They wanted everything just going up and to the right all the time. So, fine. What's the plan, though? And this is why I wish we had a decent press who would sit down and Jerome Powell mumble something about, long run economic growth looks fine, blah, 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 blah. It's like, dude, what's the plan? Price to book is at levels hardly ever seen before. What's the plan? Where are we going with this story? How's this work out for the average person? How does this make the country stronger and more durable? And they can't answer it.
No, I mean, in no way it does. I mean, it gives us a plastic face. It gives us the appearance of prosperity, but you've got a lot of pain that's there for the average citizenship. I mean, if our government is leading us in the right direction, the large majority of the populace is benefiting instead of just those that are surrounded by the halls of power. And what comes to mind is the Hunger Games. You had the Capitol that is completely detached from reality, and then you've got these all other, I can't remember what they call them, but communities that are progressively in more pain and more pain and more pain. And there's nobody in the halls of power that actually understands what they're going through, right? Except for the few that the one or two that actually wake up, and then they have their own issues because they're detached from reality. But the thing that you go back through history, 40s, 50s, and 60s, they were no smarter. We're no smarter than they were then. Yes, we have more information today and we have more access to information, but we have less wisdom, I believe, to know what to do with that information. So there was a period of time where information was power. And if you had information, that made a difference. Today, information is a commodity, but what is very rare is the desire and the hunger for wisdom to know what to do with that information. That's one thing I love about Proverbs is God says clearly, there's no strings attached. If you ask for wisdom, I will give it to you. And how many people actually ask for wisdom? So I think we're a lot more emotionally weak today than what they were then. And the government's feeding on that for their own pockets and for their own power positions. Because in 2008, we got back to long-term fundamental price value. So if they'd have just let the system work itself out on the other side, then we would probably be back to the wealth spread across the country. The middle class would be strong and resilient. We would have new products today because innovation would have been able to come up in that desperation and that time that people would have had during that bad economic environment. And we wouldn't be worried about these type of valuations and emotional weakness leading to just pure greed and speculation for probably another 40 or 50 years. The problem is they never allowed that to happen. So now we're in this super bubble that unless they can pull it off with perfection, and humans can strive for perfection, but we're never going to reach perfection unless they can pull it off with perfection and reset the rules going forward completely and wipe out all the lessons learned throughout history. This is going to end with a ridiculous amount of misery for the average individual, but especially for those that are in the capital for the Hunger Games situation, because if they're not wiped out on the other side of it, then the people are probably going to tear the walls down to the Capitol and drag them in the streets and have some, express their own pain in a physical manner on those that are in power. I'm not calling for that. I'm just saying that's happened throughout human history.
Hello, I want to take just a quick break from this program here to tell you about Well, what I'm up to. This is the pond that's on the property that Evie and I own. And you know what we're doing here? We're getting ready for some hard times, we think, but we're also doing it in a positive and loving and open manner. And we're building soil and building abundance and doing all of that and growing food. Why are we doing that? Because if you're like us, you know that the world is going in a really not good direction. We understand that there are risks out there that are new, right? There could be a financial accident. We know there's a fiscal train wreck coming, probably a monetary train wreck coming to the United States and the world by extension. We know that there's the possibility now of a new world war. There's all kinds of risks out there. Nobody's talking about them. Well, we are at Peak Prosperity, so this is an invitation to come join our community. It's been running for about 15 years. I'm your information scout. Every day I wake up, I'm scouring the world, I condense it. My superpower is taking complex topics and presenting them back to people so they can, A, understand them, but B, take action on them. So I want to help you protect your wealth, build more wealth. I want to help you be more healthy by understanding that we have a toxic food system that's out there to get you addicted to toxic substances so that then the pharma sick care system can sell you cures for all that toxicity you just ingested. I want you to understand that this, nature, really important for your child's development, your grandchildren, for your own. It's time to reconnect with the things that are important. That's what the Peak Prosperity community is. So you're invited to join. A lot of entrepreneurs there, scientists, doctors, lawyers, architects, you name it. We've got people who've been successful at life because they're open-minded, they're curious, they're learners. And this is a time to learn. We'll give you a 30-day money-back guarantee, no questions asked, because we want to make sure that we're a good fit for you, and you're a good fit for us. Consider joining Peak Prosperity. That's it for now. Thanks. We'll get back to our programming, and I hope to see you at the website soon. So here's some wisdom, as far as I can tell, right? The Founding Fathers wrote a lot of wisdom into the Constitution, the Bill of Rights, all kinds of things, right? And they were well-rooted in God and understood, I think, their proverbs better than I ever will, right? So there was wisdom in that. So here's some wisdom that we've lost, which is that the reason, you see these comparisons sometimes, people are like, why is United States so much more dynamic than Europe? Well, it's because Europe's gone down this path where it's got an administrative state and it's overweening and too many regulations and all that stuff. So there's a balance you have to strike between freedom and administrivia. Right. And I get it. You could be too anarchistic. No rules is no good. But there's a balance point. And Europe's clearly tipped way over that balance point. Right. They are not. It's not a free country, a free continent in any way, shape or form. They are not dynamic. And so people, from Europe will come here and go, wow, you can make mistakes here. And there's this entrepreneurial mindset. And you can, you've got a culture that really supports all of that. But we're also tipping down this point where you have a lot of folks, and I think that's what we just voted against, right? That's what I hope the Department of Governmental Efficiency, DOGE, is going to do, is start getting us back to this idea that freedom leads to prosperity, and we've tipped over that. And the second thing is you need a middle class, a solid middle class. That is the stable foundation of our country.
Yes.
And instead of having the wisdom, which Brett Weinstein described to me one day as, he said, wisdom is the ability to practice delayed gratification.
Good statement.
Right? You're going to study instead of hang off the chandeliers. You're a CEO and you're going to think, maybe I shouldn't take 500 times the average salary of the person. I'm going to delay that a little bit. I'm going to spread that wealth and create better things. So I've been talking about this in the context of that shooting of that healthcare CEO. And this is collectively across all of the insurance space, right? For, not just that one company, but, workers' earnings, up 27%, but premiums are up 55%, deductibles up 111%, which, come out of workers' earnings at the end if you have to, access medical care.
Mm-hmm.
This is a racket. This is just treating the middle class like a disposable, squeezable turnip, right? And this is just healthcare. I could show you similar charts, Paul. Do you know we pay 10 times as much for cell phone service than you do, say, in Hong Kong?
I didn't know that.
A good family plan might be $300 a month here, and Hong Kong is $30, right? Mm-hmm. It's ridiculous. So cell phones are a racket. Health insurance is a racket. Insurance is a racket, right?
Mm-hmm.
On and on. So it's just all rackets, and all of those things are just individual corporation sectors just squeezing and nibbling into the middle class. But it's like termites in a house. They're going to destroy the very thing that gives them the thing that they're able to destroy in the first place. I feel like there's no adult supervision overseeing this at this point. Everybody's just grabbing what they can for themselves. Where's that we're in this together thing? And that was the anger I saw people displaying, because United Healthcare has a practice of denying 31% of all claims because it's their business practice.
Yeah.
We know that if we deny 31%, only 10% of those people are going to have the fortitude because they're sick, to see it through and to get through our gauntlet and have a successful claim. So we make it as hard as possible to people who by definition are not at their best just because it's our business practice, right?
It's immoral and it's evil and it's pure greed. And only weak men give over to that. Only weak men give in to their base animalistic desires. That's not what makes us better as a society. And Chris, go back to 2010. Obama is supposedly for the people, and hey, we're going to do this health care and this thing's going to be great. No, but let's judge it by the fruits. Okay, that's led to a society to where I was shocked at the number of people. There was no remorse for the execution of that CEO. I mean, there was none. And you think about what happened with that family, and all life is valuable. I believe all life is valuable. Even evil life at a point can change. But we also have laws and justice in place for treason where there are people that need to be executed, even though that life is valuable, because they put the rest of society at risk. So what we have in the halls of power is, obviously, if we go back to that 2010 decision, the American people were sold a bag of poo, is what they were sold. This is going to be better for you. There was all this euphoria about how this is going to be great. And the fruit of those actions has been a burden placed on the American people, to where now you have the type of weak individuals that are running these companies. And instead of going, you know what, our business is to cover the healthcare costs of those peoples that pay us premium, to make their sick experience or end-of-life experience as easy and as low stress as possible. But no, that's not what they're doing. They're not being fiduciaries and fulfilling the obligation. What they're doing is serving their own base desires and going, hey, let's play some statistics. If we can, say no to 31% of the people and only 10% have the ability, fortitude, or knowledge to be able to fight us, now we're 20% more profitable. And I, as a CEO, can have one more big house, right? And it's just so criminal and evil, and it was done in such a deceptive way that the American people didn't understand it until the administrative class was so in depth and in charge, that now you've got a mountain of regulations and paperwork to cut through that's overwhelming to change it. And it's just absolutely evil.
It is. And this is speaking of that Obamacare, it was phased in 2014 finally, and this is the price of the stock of United Health Group, UNH here, on a 20-year chart. And this is the moment where, Obamacare came along, and you just saw it was an orgy of profitability. Billions and billions and billions of stock options were rewarded to the C-suite over a period of time because, they won the lobbying game. They successfully lobbied. And the Obamacare was the largest single giveaway to an industry outside of, I think, the defense stocks, right? It was just this big, giant giveaway. And to be fair, it wasn't just Obama. It was the Uniparty. This included a lot of Republicans, rhinos, like non-conservative conservatives, Anyway, I think we have to face up to the idea that our congressional staff is not up to the job of really doing what's best for the country. Individual sectors aren't anymore, right? And so that's why I think people need to be ready for the idea that when we look back at this chart again here, let's take just 1 second because I have to change screens. But when we look at this, everything has to go exactly right for this chart not to turn into another complete disaster. And by the way, Paul, I will be a big bullish buyer again when we're back down into this long-term historical range again. if other things, like if we have a smart energy policy in our country, which
Yeah.
I'm not sure we're going to get. I hope we do. You know, I wanted that energy secretary position because I thought I have a plan, but hopefully the new guy's got a great plan. I can't wait to see what it is. But man, we need some sense of togetherness in this. I think America first again. I was disgusted. I've been disgusted the whole way through. Trump is elected, and the Biden administration has been doing everything possible to screw that up, right? Long range missiles into Russia, a Georgian color revolution, a Romanian election overthrown, and now Syria. At any rate, it's been a never ending disaster. But on top of that, I saw Biden come out just 2 days ago, and he said, well, now we're going to help, the Syrian people rebuild, billions of dollars for them. And we got people freezing to death in North Carolina. And I'm sickened by it. Like, it just shows they don't care about Americans. They don't care about middle class. They don't care because they've forgotten. They're weak men, Paul. They have forgotten why this country is great and why they even have $1 billion to give to Syria or whatever next project. You got to take care of your own house first. This is what a parent needs to do. You understand this. If you don't have a solid home, all the rest is for naught.
That's
make
right.
sure your home is solid. So I'm kind of hoping we get back to some basics here over the next few years.
I'm hoping we will, and we will, Chris. I mean, we will. We just don't know when that's going to occur, but something is going to change. And then, because that's that cycle, Bible front to back, we can see it. Good men create good times create weak men create hard times. I mean, that's embedded in our human psychology. It's embedded into our historical books. It's embedded into everything. But our human nature and the psychology that we have, and our inability to really pull ourselves out of our dream for the future, anchor ourselves in the present, and learn from the mistakes of the past, is a weakness that we have in our human makeup that causes us to continue to repeat these cycles over and over again. And I think that's so important. The Bible says there's a way that seems right to a man, and in the end it leads to death. And that can be applied in all aspects of our lives, but more so on a societal level, because we see that as a people, as nations, and as countries over longer periods of time. But we see those same short cycles in our own lives. I mean, we all can think back throughout history, through our own lives, and go, wow, it's by God's grace that I didn't die because of that decision. Or, had I made a different decision back then and been seeking wisdom instead of instant gratification, I'd be in a better situation today. Or, hey, if I'd have made a few sacrifices back then, I would have more fruit today. That's one of the great things and great honors of what I do in working with people. And I've got people, Chris, that I've worked with for 26 years. I've got people that I've worked 20 years through the end of their lives. And we build these relationships where I've earned their trust, and I hear these stories, especially towards the end of their lives, about what they wish they had have done different. And in every case, they wish that they had sought wisdom more, had been more loving and caring of their families, because later in life, if their kids are older, they can look back and realize that, hey, I didn't quite build the foundation for my kids that I really wish that I had. I just couldn't have seen it at the time. And that's where we are in society right now. We have narcissistic leaders that are serving their own desires at the expense of the American people. And there's a way that seems right to them that's already leading to death in our society through the demoralization that's out there. That's why our drug addictions are so high. That's why our suicide rates are so high. That's why there's so many things where these people are, the addiction levels are so high, because they've absolutely removed the ability for the American people to be creative and pursue their desire, because they've got this administrative state that's locking out the average individual. And I've got one chart that I've got to show here, Chris, because it came to mind just a minute ago about the administrative state. Elon Musk reposted this. This is the big part of the reason your children are not getting a good education, from the rabbit hole. But look at this: growth in administrative staff, principals, teachers, and students in U.S. public schools. Now, my wife is a teacher that cares about her kids. And I've noticed years ago, why in the world do you need so many people in the, at the Board of Education main office? Administrative staff since the year 2000 is up 95%. Principals and assistants are up 39%. You've got, and then principals alone are up 10%, and then teachers, right, which are what matters the most within the system, are only up 5%. And our education system is not getting better, but those that have been educated in the halls of power are so self-serving that, hey, I'm going to stack more papers and more requirements and more measurements on top of the teachers, instead of get rid of these people and get the teacher to student ratio way down a lot. And now we're doing what's better for our future generations, instead of our bragging rights of those of us who were fortunate enough to know that a college degree can open doors that you otherwise wouldn't have.
Well, to say nothing of local property taxes, right?
Oh, yeah.
It drives me nuts that we have all that administrative staff and they're all earning $200,000 salaries up there. You know, the superintendents and the associate deans of diversity or whatever they got going on and all these things now. And by the way, those people could go away entirely and a whole year would pass. And you know what would happen to the educational standards for our kids? Nothing.
It would be better. Yeah.
Probably better. Probably would improve.
It would actually be better. Because teachers can spend more time teaching instead of pushing papers to justify some ridiculous administrator's $200,000 salary at the main office when they wouldn't survive 6 months in the classroom on a regular basis. Some of them got there from the classroom. I'm sorry.
Well, if it turns out AI can replace all those administrators, now we're talking.
Yeah, that would be an actual great use of AI. And now the teachers can actually do their job, discipline the students, spend time with the students, and point them in a better direction and get that ratio down, where now these teachers can build relationships with the students, get to know those individuals, and help overcome their behaviors to make them wiser, stronger, better citizens in the future, and help, make America great again.
Yeah. Now the whole administration staff, all that, I think that's the tyranny of the experts. We've just come through this whole long reign where, you need expert this, and you still watch the New York Times trying to sort of defend the expert class, experts say, as if that means anything. To me, as soon as you say experts say, Paul, immediately I discount that. I'm suspicious of it. And I think you're probably just blowing smoke. I no longer trust experts. I don't trust them at all, right?
No.
On pretty much anything at this point. So, because we've been lied to comprehensively about a lot of stuff, right? So, it is a quick aside, and this is astonishing to me. We have experts have said that. Let me get my pull up. Yeah, it's not that. That's closer. All right, we'll start here. So these experts have said, we need to go into green energy. And they did this heavily in Europe. And they did it particularly in the UK and in Germany. And the UK now, they're so far down the experts say class that they're feeding an additive to cows called Bovaer that stops cows from farting. And everybody has to accept that. And people haven't been. That milk is sitting on the shelf. So the UK Parliament's considering a law that maybe they have to pass a law now to force everybody to drink that. And in essence, that you're not allowed to sell non-treated milk, because experts have said this is how you have to attack climate change. But it's gone all the way down to this crazy thing. Nobody's ever over there looked at how much, what is the total contribution level of cow farts relative to China putting in 2 new coal plants every week, right? It's just stupid, right? But that's where experts get you over time. It's like they start debating angels dancing on the head of a pin kind of stuff, right? Yeah. Meanwhile, nobody's looking at the fact that because they've pursued these green energy policies, the UK energy prices are high, ridiculously high, and they are now hemorrhaging industry. And that's making everybody poorer, right? But the experts, man, they are undissuaded, right, by all this. They are more certain than ever that we're going to put this additive into its cow farts. It's gotten to that point where I think, I'm hoping that now we have this new era where people can back up and say, okay, I see all these administrators in schools. Point to how that's made our students stronger. it has contributed to a better outcome? How would we know that this has helped? And the answer is you can't. It's just more expensive. In fact, it may have been unhelpful. And that's what I'm hoping we can start getting back to. I want common sense. I actually trust the guy up the street who's the plumber a lot more than I trust a Federal Reserve official to understand and diagnose what the problem is.
Oh, absolutely.
Because I talked with him just last week, and he's like, yeah, the government's printing and spending too much money. Like, there you go. That's it. That's the whole thing.
Yeah, that's right. And he understands reality far more better than those that are in the halls of power and completely detached from it. It's just amazing how foolish that they are. And the reality is, the average individual has ridiculous amounts of wisdom, and I love common sense. And law, Chris, that law forcing people, making it a law that you can't sell this milk, that's tyranny, right? Like the law that you shall not murder. Most people are not going to murder, but that's going to happen within society. So you have to have consequences. That law's in there. It says, if you do this, here's what's going to happen on the other side of it. So that law is establishing protection of the people. But a law to force you to drink something that the market is not choosing is tyranny. And common sense. I don't know if this is true or not, but I saw somewhere on Twitter, and I'm sorry I can't give the credit. It's buried in one of my bookmarks somewhere. But supposedly Bill Gates comes out and says that cars produce more, cows produce more damage to the, climate than what cars do. And somebody responded and said, okay, if you believe that, I'm going to go lock myself in the garage with a cow overnight, and you lock yourself in the garage with a running car, and let's see who's alive the next day. Right? I mean, it's just so ridiculous what they're doing. I don't know if that's true or not, but that's common sense that the plumber's going to have that Bill Gates obviously doesn't.
But, people will rationalize anything. We're not rational. No. We're rationalizers. Right. And that's what we've been talking about, is this whole idea that where people are trying hard to rationalize this bubble that we're in, or set of nested bubbles, the super bubble we're in, right? And eventually you say we're at a permanently high plateau of prosperity. These earnings are sustainably, great forever. And of course, when you look at history, it says, no, things come, things go, cycle up, cycle down. The problem for me, Paul, the reason that I preach my resilience so hard is I'm worried, and maybe I just worry too much, but I'm worried that, normally it used to be that animal spirits would take over, little bubbles would develop, and you'd fall and it would hurt, right? You were 3 rungs up that stepladder. Man, that hurt when you fell. But the Fed's been there just putting more rungs on, and I'm worried we're like 12 rungs up now, and it's going to more than hurt when this bubble bursts.
Well, it's a high wire act. I mean, this is Evel Knievel territory. What is it? The guy that stretched across the 2 skyscrapers in New York, during the 1920s, and does the high wire act.
Was it the Walensky brothers or something like that?
I think it was. I think it was, and I'm just trusting
flying Walenskys. I might have that right. I don't know.
But we've seen that throughout history. That's really what we are. We're in the midst of an Evel Knievel act or a high wire that the consequences of failure are going to be too costly to bear. And that's the hard part, is the average individual has just been doing what they've been told to do. And they've been looking in the rearview mirror and going, wow, if I'd have just been a passive investor to begin with. But we're not passive drivers. The best drivers are defensive drivers, and there's a time to be offensive. We look at sports because there's offense and defense. If you've got a better offense than a defense, some teams are over others. So we have to have this balance in the markets and the economy. And when we get into these bubbles and this delusion, we completely walk away from the foundation. And just think about, the story of the 3 little pigs. What does that tell us? And why do we tell kids that story? A straw house is where we are right now economically. Some companies are in the wood house, and we need to be building brick houses that can withstand the inevitable storms that come. And our weak leaders, because of their greed, are allowing the administrative state and surrounding themselves with weak individuals that are serving money. They're not serving the people. That that money is their God is setting up, temporary benefit to the people. And I think that's the reason why when things get bad, because money is their God, they're like, here, let's give everybody money because that's the answer. But that's not the answer. It's a fundamental foundation, and building our nation with a strong middle class is a solid foundation. And that's a brick house that good things can happen in the future. And we're a straw house now because it's all, the wealth is held to the very, very small amount. And if you're fortunate enough to be in that class, then your job is going to be to protect it going forward by making different decisions and pursuing wisdom. And if you're outside that class, we've got a society right now that makes it nearly impossible for you to get there because you're coming out of school with massive amounts of debt. You're having to buy homes that are ridiculously affordable, that the likelihood of you getting that paid off is very slim. And yeah, there's opportunity for advancement, but it is far fewer right now and far more rare than what it was 40 years ago. And this path is unsustainable. And it's my job to help people recognize that, play the game by the rules that are forced upon them, and have strategies that can give you the opportunity to limit the damage done to the portfolio when reality comes home to roost.
Well, very well said. And that's our time for today, Paul. So if anybody's interested in working with Paul and his team, please go to peakfinancialinvesting.com, fill out a simple form. Somebody will be in touch with you within 48 hours. And it is time to both understand when to drive offense and when to drive defense. You gotta drive both ways these days. And that's what a risk managed portfolio does. It's a rarity in these times, Paul. I think most advisors today are kind of advocates for the passive, and they play a very passive game. So they will passively diversify you into a variety of passive vehicles. And if you understood the charts we were showing, this time is not different. You're going to need a risk-managed approach to this whole thing to come out ahead.
And on the other side of it, there'll be a period of time where we won't have to manage risk. And I'll spend a lot of time saying, don't worry about the volatility. The fundamentals look good. Path of least resistance is higher. People are going to be like, who are you? That'll be a fun time.
Yep, indeed. All right. Well, with that, Paul, thank you so much for your time again today. And thank you, everybody, for being here with us. We'll be back with you next week. Bye for now.